Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Your Money, the personal finance edition of Merryn Talks Money. And these bonus podcasts, we talk about the best strategies for making the most of your money. I'm Merryn Somerset Webb, and with me, senior reporter and author of the Money Distilled newsletter, John Stepek.
Hi,
John. Now, listen, we really like getting questions and feedback from our listeners, don't we, John? Back me up on this.
Yeah, it's great. It's really interesting.
And so we're going to answer a listener's question today, ask us to talk about non-equity baskets. But before we get on to that and explain to you what a non-equity basket is, of course, we're going to go through some of the other notes we've had from listeners, because we promise you we do read them all. Not all of them become episodes, but we definitely read them all and we think about them. Right, first up is Tracy. Tracy is a long-term listener, and she takes issue with our idea about holding cash. She feels that holding 6 months' worth of expenses in a cash ISA is sensible for most people, but not for everyone. She cites two other groups of people. First, they're saving for a first house deposit, saying it doesn't seem sensible for them to invest a deposit in an ISA. And the second category would be the elderly. She talks about her mother. Tracy explains her mother has just sold her house, now lives in a care home, and the cash from the house is being used to pay care fees. Therefore, it doesn't make sense to invest that cash. That's actually an extremely sensible piece of feedback, I think. And one thing I would say, John, I don't know what you think, but it might be a good idea if you're talking about quite a lot of money from the sale of a house, just leaving that sitting in one cash account could be a mistake, because you're only protected up to £85,000 in each bank account. So that's worth thinking about.
Technically, there is coverage for temporary big sums. If you are selling a house and you're between houses for a few months, then double check with your provider. But I think there is cover for up to $1 million in certain circumstances.
But that's not what we're talking about here.
No, absolutely not. This is long term. So yeah, she would have to split it.
Yeah. And there is a case, and again, it's probably something we should look at properly another time. There is a case for holding short-term gilts and just continuing to roll those over, getting the income from that. And there's some tax advantage there as well. So there's definitely a case for that if you've got a very large amount of money that you're holding on to for an elderly parent who's in a care home. Because as we know, those care homes can come in at $100,000 a year plus, right? So, you know, I hope it was a big house, Tracy. I hope it was a big house, and I hope your mother as well. And the other thing on the housing point, that's absolutely true. The last thing you want to do if you're saving up for a housing deposit is to put that money at risk in stock markets, because it's short-term savings, right?
Oh yeah, absolutely. And to be fair, we've never said that. I think the slight thing Tracy was taking issue with as well was the idea that the cash ISA allowance should be reduced. And I think that's a slightly trickier concept, because I don't think that many people saving up for a deposit, they're going to be lucky of 20 grand, which is the annual allowance for 1 year, let alone multiples of that. I can certainly see why you would want to keep a large sum of cash in an ISA so that it's tax-free for the second scenario, a kind of elderly person in care home fees. At the same time, I think there still is a discussion to be had about whether the cash ISA annual allowance should be as generous as it currently is. But there's an element of swings and roundabouts there.
One other thing that we wanted to look at, Lucy got in touch to ask if there are any free or low-cost personal finance resources specifically for women. I would say on that, but I'm interested to hear what you say, John. His answer is yes, there are loads of free, low-cost personal finance resources. Welcome to the Merryn Talks Your Money podcast, on which is free at your favorite podcast provider, and we do a lot on personal finance. Then, of course, there's Money Saving Expert. There's Money Week, where John and I both used to work, which has a lot of free stuff on its website. There are hordes of websites. There's Blonde Money. John, can you think of some others?
Boring Money, Holly Black's
Boring Money.
one. Yeah.
That's what I meant, actually. Yeah, so there's loads.
Blonde Money's good too.
Yeah, that's good too.
It's very macro though.
It is, yeah, not quite what Lucy's after. So there are lots and lots of free resources. The Money Saving Expert is the go-to for so many people when it comes to looking into the granularity of personal finance. I'm not sure that you need to look at anything specifically for women. The rules are the same, men and women. There are a few things that are different about female personal finances. Of course, we are the ones who take perhaps longer breaks to take care of elderly relatives, to look after children, etc. So maybe there are issues about how much we should put into pensions, etc. But the rules don't change. They're the same for everybody. So I'm not sure that you ever need to look at female-specific finances. I say that as someone who wrote a book on female-specific finances about 20 years ago. The rules are the same. the emotions might be different. Is that fair, John?
I think that's fair. The one thing I would say, and I think one of the things that came across in your book originally, is that it's not so much about the rules as the situations. And obviously that's always a tricky thing to talk about because people simultaneously kind of like the idea of equality, but also don't like the idea of admitting that there are differences and that there are situations like pregnancy, for example, which are almost bound to cause differences in your life path that are not the same as those of the average man. What kind of always irritates me about this discussion is that it kind of often focuses on kind of stupid things like, are women more or less risk averse than men? Which is clearly just situational, as opposed to focusing on the kind of more important things about, well, okay, what should you do if your career is more likely to not be a straight kind of line from 20 to 65 and more likely to be something that's broken up? And I actually don't think there's enough coverage of those things. I think we like to sweep those under the carpet. That's kind of a separate issue. That is more about the different life path of your average woman compared to your average man.
Well, maybe as we've got John the feminist on the show, we should do.
I would never describe myself as a feminist. Only creepy men describe themselves as feminists.
Really?
Oh, totally. Sorry, it's a thing. I like women and I sympathise with women and their issues, but I think that you can only be a feminist if you're a woman, actually. But anyway, that's a whole different topic.
All right, Lucy, I'm going to take that one offline with John. But I think we'll definitely dedicate a podcast over the next few months specifically to the different pathways to pensions, I think is probably what it's all about for men and women. We'll come back to that one. Thank you very much for it. Right, one more. Ian got in touch about the government's move to abolish the lifetime allowance, how it affects people, and if there's any way he can get back tax that he's already paid. Oh, Lord. Took early retirement in 2020, a mixture of defined benefit and defined contribution pension schemes. My sympathy's slipping away, Ian, slipping away. Over the years, my DC did pretty well. Okay, it's gone. And I ended up with my total pension exceeding the lifetime allowance. Definitely gone. In fact, I stopped contributing and got individual protection status. Do I have to go on with this? However, since then, the government has abolished the lifetime allowance because it was coming too punitive for public sector employees, especially senior doctors, and even Sir Keir Starmer had his own specific civil service pension scheme that exempted him from the lifetime allowance. Yes, he did, by the way. My sympathy for him has also entirely evaporated. So my question is there any way I can get that tax back now the lifetime allowance has been abolished? Now, there may be a more complicated answer to this, but my answer is no, I don't think so. John?
I mean, I can't imagine that there is. And I think the main thing that Ian's email illustrates is the problem with the government constantly changing the rules. So it creates, I mean, net, Ian's a winner. He's had to apply for lifetime allowance protection, which means he's even got a higher lifetime allowance than most people had. But the point is, it's the fact that it does keep changing, and that's very detrimental. It creates winners and losers, and it also puts people off saving into pensions, understandably.
All right, well, leaving that one, we are now going to go on to today's actual episode. Today, we will be answering a question from Nalima, and she says, at 68, I self-manage my money, which is all either in a SIP or an ISA. Well done. I increasingly want less in equity investments and more in safer holdings. I wish to reduce my 60% equities. I have cash ISAs and very short-term gilts. Where else can I put my money to increase my non-equity basket? Is it money market funds and bond funds? Well, this is a really interesting one, isn't it, John? Because 60% equities at 68 when it's self-managed. I'm not sure that many financial advisors would necessarily advise now pulling that much below 60%. And when we were looking at this the other day, weren't we, and wondering exactly what it is that Nalima is after here, and that there are, if it's income you're after, there are a lot of what you might call safe income equity products. And one of the things that you and I look at a lot is the dividend heroes at the AIC, so the investment trusts that have put their dividend up every year for however many years. I've actually put a new list just in the nick of time. So lots of them. Scottish American has put its dividend up for 51 years, Murray Income Trust 51 years, Brunner Investment Trust 53 years, etc. Caledonian Investments 57 years, City of London 58 years. They're not going to break that record. So what you know is if you go out and you buy the City of London Investment Trust, you can't guarantee that dividend will constantly be put up to match inflation if inflation goes berserk. But nonetheless, what you know is that it's more than likely to rise every year. So that seems, if it's income you're after, and hanging on to your capital at the same time, that would seem a reasonably sensible way to go, even though it's still an equity product. So that's one thing to look at.
One of the things here is it's just being curious as to what Neelima's overall goal is at this point. I mean, if she's got more than enough money and she actually just wants to reduce the absolute amount of risk that she's taking in her portfolio, then I can get why you might want to move more money towards kind of cash type assets, because you just don't want to take any risk bar the inflation risk. It's tricky about knowing exactly what she's aiming to do. And I know, I mean, because Neelima's been quite a regular correspondent over the years, and so I'm pretty sure that she's quite clued up. And the fact that she's managing her own SIP and all of that is impressive. But so I'm sure she knows what she's doing. But in the absence of that kind of goal structure, I think it's much harder to say.
I suppose the real question is she looking to maintain her income, or is she looking to hang on to her capital 100% in real terms, or is it both? These are very, very important ways to look at it. If you want to preserve your capital, do you need to preserve it in real terms? Do you just want to preserve it in nominal terms? Why do you need to preserve your capital? I mean, that's the other question that we should often be asking people. What are you preserving your capital for? Is it because you want to leave it to somebody? Is it because you're frightened of these, care home fees, etc.? What is it? And one of the things that we often ask people is, why wouldn't you just die broke?
Yeah, aye.
Why hang on to the money? What's going on there? So that's a good question to ask yourself. But outside that, yes, it is money market funds. It's short-term gilts. Be quite wary of bond funds, actually, with the inflation environment. There's a lot of crazy stuff going on out there. I'm not entirely sure that I would look at a bond fund these days and go, oh, look, if I buy that, I'm safe. You're not.
Yeah, I kind of feel with bonds, you probably need to be looking more at, and this is quite complicated, but it's kind of structuring your own bond ladder type thing. Because the real problem with bond funds is that they constantly sell the bonds before they mature. And so that means that they can take a whack when interest rates change. Whereas if you're an individual holder, you can hold the bonds. And I mean, you'll still get whacked by inflation in terms of, if you hold it for 5 years and it turns out the interest rate and the gilt wasn't enough to compensate you for the inflation over that time, you'll have lost money in real terms, but your nominal money will come back. So I think if you're really worried about the protection of your nominal value, then you have to look at individual bonds for yourself if they're longer term. Obviously, money market funds are that is what they are. They're just short term treasuries and bonds that are issued and then refinanced by the government very rapidly. So they're basically just cash accounts, but in the bond market.
Yeah. So in the end, if you want to be safe, you really are cash equivalents.
I think
bringing down your equities and just moving into cash. And the other thing is that we're not going to get deeply into gold now, but that's a sort of cash equivalent that might or might not preserve the value of your capital. So if you have a look on the Bloomberg website, you'll find lots of stuff about gold. And obviously in our podcast last week with Sebastian Lyon, we talked about gold at some length. I mean, that's worth thinking about, but of course it's not going to guarantee the preservation of your capital, because it's not like that.
That's important to emphasize, just because I do think that people get, particularly when gold's going up, as it is now, people start to believe that it is something that invariably protects your capital. We like gold on this show. We think we've been talking about you should have part of your portfolio in it for 20 odd years now. But the point is, it does go down in nominal terms, and it does go down in real terms. If you buy it and it falls by 20%, which is perfectly possible, then if you have to sell it, then you're going to make a 20% loss. So it's not like cash from that point of view. Just think it's important to emphasise.
I think we're confident saying that it will preserve the value of capital over the very long term, but then one could argue for a long time about what the very long term is.
Exactly.
And I suppose the only other option for Neelima, which is something that I'm sure she's thought about already, is an annuity.
Yeah, again, if she's really worried about her money running out, then that's something to consider.
And it's also a lot more attractive now if you think about it in terms of the way that pensions will be taxed going forward. In the old days, I'm slightly assuming that she was looking to leave her money to somebody, hence the need to preserve the capital, etc. It used to be you could just leave your money in your pension and it would effectively become a trust fund for your heirs. But this isn't going to be the case anymore with the reforms, or should I say changes to pension taxation. It's now going to be liable for inheritance tax and then liable for your heirs' income tax after that. So that's quite a big percentage of the capital that's going to vanish on your death anyway, assuming she's in the zone for inheritance tax. So with that in mind, given that you're likely to lose the majority of that capital if you're reasonably wealthy when you die, makes more sense than it used to use the money inside that wrapper to buy an annuity, which will pay you out a relatively good income because annuity rates obviously have gone up quite a lot recently. Is that fair?
Absolutely. And she also doesn't have to spend all of the money on an annuity. And, she can get a certain amount of inflation proofing as well. Although obviously that means that you have to pay more for the annuity. If we were having this chat 8 years ago, then the idea of buying an annuity would have seemed kind of only if you were really desperate for certainty. But at this point, it's definitely something to throw into the mix.
Yeah. Okay. Anything else, John? That's all my thoughts on the matter.
Yeah, I don't think I've got any more thoughts on it either. I do think it does boil down to what are Nilima's overall goals. And the thing is, 68 is, I don't know, but I feel that it's quite a tricky age in terms of thinking about, you might actually have much longer to go, and alternatively, perhaps, you might not. And so I think it's worth kind of like thinking about in those terms of what is it that you also want to achieve in your remaining time, and thinking about what you want to do there. I know that's all a bit existential and grim, but there we go. That's pension planning for you.
Thanks, John, for giving us that note to end things on. Now, I would just say, by the way, that we do not know everything about Nilima's personal circumstances, so absolutely nothing that John and I have discussed here today is to be construed as advice either for her or, for that matter, for anybody else. We're just shooting the breeze about what we think, right, John?
Yeah.
Do not take this as advice, and if you want to do anything like we've discussed and you're not expert on these things, do please consult a financial advisor. Thanks for listening to this week's Merryn Talks Your Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Summer Sadi and Moses Andam. Sound designed by Blake Maples. Questions and comments on this show and all our shows is always welcome. Our show email is merrynmoney@bloomberg.net.